Hi, this is Randy Finney with Right Side of the Chart, and this is an early session update for Monday, May 20th, 2024. It is 9:59 a.m. Eastern Time as I'm starting the video, so we're about 30 minutes in the trading day. And here's what I'm gonna do in this one. I'm gonna try to get it all in there. By all, meaning I want to start out definitely with the equity markets and then also talk on treasuries. I kind of fired off a post to you this morning, and in a nutshell, shows the relationship, which is unmistakable. And there's a bit of a lag when you turn. I'll talk on that briefly. So we're going to go in this order. Indexes, I'll talk on the big ones, the NASDAQ 100, S&P 500. Brief look at the equal weighteds. I want to show you a couple breadth indicators, percentage of stocks trading above their 50, 200-day moving averages, indicator that I have, low volume indicator. As I mentioned, we'll get to treasuries, euro, US dollar. If I can get through all that and we're not going too far past the 30-minute mark, I will then hit the other part of really, what I've been trading and focusing on and highlighting to you recently, which are commodities, particularly the ones I like right now, the grains, natural gas, and crude oil. And then if by chance I can wrap this up, I'm going to try to rifle through these and not go too deep. I saw when I got back into town this weekend, I saw a thread and had more comments than I've ever seen. And I only got down to the first half dozen or so, or a dozen. And it was a lot of talk on some meme stocks, and that plays in. So I'm going to, if I don't do that in this video, I'll get to them later. Or if you're interested, AMC, GameStop, it's really not my wheelhouse, but it speaks to both the markets. And I do have levels on the charts and can talk on that. So I know it sounds like a lot. Again, equity markets, bonds, a couple indicators. Oh, and in the Mag 7. And then, like I said, if I can't get everything in here, I'll truncate the video and then stop it there and then cover commodities in a separate update. Okay, so on that, and speaking of vacation, I didn't get around to posting anything. It usually is just a full pack event. We do this. It's a thing from my wife's company once a year, an awards thing, and it's constant. We are between excursions and couple hundred people there, and dozens of which we know, and that's constant dinners, drinking, partying, and all this stuff. So we just did what we could to get back to our hotel room, pass out. Anyways, I just want to let you know that everything, and I check the markets from time to time, but every single thing, if I was in last week, I wouldn't have said one thing different that I hadn't been saying for many weeks now. And I'm going to summarize that here. So again, the trading plan was laid out. It was clear, and what would happen and what the levels to watch. And that is this, so, kind of recap. T2 was hit back here where I stated the odds for various reasons were good for a reaction. When T1 was hit, I said, no, hold tight, stay short. And then that's where I covered reverse bounce, game, good part of the bounce. Trading plan was very clear, and I hadn't waffled on it in really since going back here, mid-April. That, short up to, but not above 433. That was the bottom of this trading range here, very well-defined trading range. And then a stop out, because I had said that if and when this trend line was clearly taken out, we tested it for about, you can see 1, 2, 3, 4 days. And then here, I'll zoom in. I said, look, if they take that trend line, it's most likely going to be a quick rip. That two things would happen. We'd go to new highs, most likely, and it would be a relatively shorter. Well, that's exactly what happened. Once it was clear, there's the first clear print above the downtrend line right here. That was on Monday, the first day I was out. Tuesday, if you missed that, then it was pretty clear Tuesday. That's a solid close above there. You don't have to squint to see it. And then, boom, there's the quick rip up. When you look at the 60-minute chart, same thing. You can see that and this shows very clear. We consolidated under it. It was certainly resistance. Again, the level I highlighted well in advance. And then, boom, once it was clear it was taken out, that's that quick rip. And that's exactly what to expect. So to me, that was, I told you guys, my, scale back in here, short up to, but not above 433, no digging in a hole, starter position, and then just stop out there. And that's what they did. So they got me. So I'm waiting now for the next trade on the markets. Again, this is my trading plan. You guys do what you want to do. And here's where I think it's going to come in at. Market, I made mention, the pattern for a long time now has been, new highs, or at least new, maybe that wasn't an all-time high, but you get these new highs, divergent highs, and you get these corrections. And yeah, at some point, so like I said, dip buyers can keep buying these dips. But this is a daily chart. So as I said before it even happened in the last few weeks, at any new high, anytime soon, particularly on the more significant daily and weekly charts, would just be a marginal new. Again, marginal means slightly. If we go up 10, 15%, what'll happen, and I'll talk on that in this video, you can burn through these divergences, and that's just out and out bullish when you see that happen. But as of now, it's incremental, and ever so slightly new high, and it still just extends the divergences, same divergences we had in place here that led to that, 8+% drop down to T2. And those divergences not only have not been taken out, but they're even bigger now. Now, divergences are not a sell signal or a buy signal if they're positive or bullish divergences. Let me repeat that. I say it often. Divergences are not a buy signal. Overbought, oversold are not buy and sell signals. They're merely conditions that indicate a trend reversal is coming, and then you got to look for the sell signals. That's what I'm doing today. One thing you want to see is this is what I call, and again, it's just a term I made up years ago. I call it potential but unconfirmed divergence, because a PPO is a momentum indicator. That's the big one I watch, and it's pointing up right now. It's headed straight up with no signs of reversal. So when the PPO starts to roll over and you get a bearish crossover, meaning that blue line there, the PPO line crosses a white line, then that's what I call confirmed divergence, because at that point you've effectively put in a lower peak, right, over the previous peaks. So when you turn there, so that's what I'll be looking for. We're overbought right now, and I will say with strong convictions, what I said before, if we punch this new high, it would most likely be a marginal, yet another divergent high, and then the most likely for me, and still is the next trade at this point, is a short. Now, if I was in that, last week, I might have just quickly jumped in there and gained some, that little pop there. Again, they hit my stops. That's fine. I had a small position, let it take it out. That was the trading plan I told you all along. Stop, no shorts above 433. My partial scale in there, waiting for additional sell signals, which we never got. And then if they pop that trend line, because again, the odds were, to me, very high that we'd go to new highs, and it would just be a marginal, but still something you don't want to ride out. Again, I'll tell you what it was right here. So when you popped it right there, we had some price resistance there. It's about what is that? I'm just going to rough it. It's about almost a 3% rip right there. And that's it. So that was kind of what was predicted. If that happened, I didn't know for sure we'd pop it, and we tested. They couldn't get through, but then they took it out, and that's that. So let's move on. What I'll note here is this is the most extreme overbought reading I've seen on the 60-minute chart in a long time. I've covered this before. You have this white line here, usually about 76 is often where rallies are capped. Not always, but if you get divergence, all the better. And so what I think is the most probable scenario, I told you, where I just said I'd let you know where the next, when the next turn is. If you believe the market's going to new highs and beyond, you're probably not listening to me right now. You want to buy this breakout, and maybe it pays out. But right now, it's not an absolute necessity, but I like to see divergence to make a case to be short, and also a break of support. This is a kind of meh trend line. It's not super well defined. It may do the trick. This one I think we'll come back to right here if you're looking for at least a near-term target. There's a lot of levels on this chart, but you can see as I just drew here, I extended this line, and right now we actually have it. We have now unconfirmed but negative divergence here on the 60-minute. I'll get to the futures in a second. You have, as I mentioned, a NVIDIA this week. I'm going to get to the Mag 7 here in a second, but there's where we're at. So really no sell signals. We just popped the highs. Got a lot of euphoria in the market right now, particularly with those meme stocks going. I'll get to that again, hopefully in this video. And that's it. So here we are. At highs, which I believe will fail soon. I'll make another case here. This is the QQQ, of course. I'll get to NQ here in a sec. Well, let's do that now. Okay, this is NQ 60-minute chart. Last time we had a divergent high on the 60 was well, not the last time, the last big one right there. That was at previous, not the last Fed meeting, the one before popped in. That was a objective, it was a kind of a pot shot, gut feel short entry, but it worked. And then we took out the big level there. That's comparable to 433 on QQQ. We all know the history. That's when T2 was hit on QQQ, and, covered and reversed, gained the bounce, started scaling back in up to, but not above that 18046, which is also roughly comparable. 433 was about right here, I think. So, but that's the bottom of the trading range there. So we popped it. And again, at that point, even though we had divergence, again, my plan was to sit tight, not add to shorts because of that. That was nothing but, and I mean nothing but bullish when that level was recovered. And then, of course, then history was, there it is. There was that trend line. I took the trend line out. And so here's a case, where I left it on the chart. Divergence was there, but it got taken out. That's bullish. And so you had the negative divergence while you were testing the trend line. And, I said if you wanted to, you could make a case for an objective short. Not me, because I was waiting and to see, a rejection there and then a break of these other levels to add. We never got that, so it went the other way. And look, we broke out, we back tested it, and then boom, that rip. Now, so here's where we're at. Negative divergence. If we make an NQ, I showed it on QQQ, it's technically you have an equal high now. So negative divergence, you can have prices making an equal high, and if the indicators are making lower highs, then that's divergence. But again, it's not confirmed. We'll need to reverse, and we could go up a little bit. This would, I could see us going up that much more. It's incremental. It's so marginal. And there's that trend line I showed you on QQQ. You have 1, 2, 3 rough. And that might do the trick. And then look, this is not the absolute high end of the range, but it's where I had the range boxed in kind of about, it's 18, I don't think you can see it in the video, 18,627 in NQ, the futures. There's a previous high, and that's right about where we are. So when you look at the futures, we're pretty much, it's not, definitely to me, not a breakout. If you want to say, 5 points, 10 points on 18,700 point index. No, that's for all intents and purposes. We're just pretty much testing those previous highs. Could be a double top high. I suspect it will be within plus or minus a couple percentage points if we go any higher. And so there's my take. Nothing's changed. As I told you before I left town a week ago, that if we punch to new highs, and if the technicals didn't change, and right now they haven't. What does that mean when they change? Well, we start taking out divergences and all that, particularly in that long term, the daily chart, weekly. Those are big to me. Then my outlook will change. So another way for me to say this is a breakout that I'm not chasing on the long side. If I was around again, I might have gained a couple percentage points and then trailed stops up or whatever. But at this point, I'm just looking to re-enter back into short positions for the reasons I'm going to continue on here. All right, so that is QQQ. Let's talk about SPY, because QQQ is not everything. SPY, you have here the same thing on the 60-minute chart, an extreme overbought reading. And again, overbought is not a sell signal. It's just kind of a condition that you get that far, and usually you'll either consolidate, maybe punch a little bit more, but the upside from that point is typically limited. There was a pretty extreme overbought reading. You went up a little bit more and you started diverging. See the big divergence there, and then a correction came. And it was a little one, wasn't much, but the point is, the upside is very limited. Chase it here. It's just the RR isn't good, the risk reward. So, and then, we had a nice divergent high here, we corrected. So that's what it looks like on the 60. But again, go to the more significant daily time frame, and here's what the S&P 500 looks like. Again, nothing changed. That was a divergent high there. We rode that short down. That was when T2 was hit on QQQ, remember? And we also had taken out the trend line in SPY. And SPY has made a new high, broke out to new highs, much cheered in the media. I could see those headlines while I was gone. And it's just extended. We had divergence there. We dropped, pretty good drop. And that was at this divergent high. And we've simply extended those divergences. So I know some of you might want to hear something different. from me, but this is how I see the charts. And oh yeah, I can see the volume tapering here. Let me show you something else here. Let's flip over to this board. Let's go to this one here. So I've shared this in the past. In it over time, the levels change. This is the S&P 500 up here, SPY. And this is what I call, this is something I came up with years ago, and I share this from time to time. I call it my low volume indicator. Again, it's it's not a hard buy or sell signal, more of a sell signal when volume drops off to certain levels. You can see down here I have a purple line at this volume level here. And what I have above in blue is the 10-day exponential moving average of the volume. Because what happens is, some days you can have an earnings report, or economic release, or a breakout, and there's a big volume surge. So to put a moving average on the volume will kind of show you, that's okay, this is where volume's trending. And so I like a 10 days, it's kind of what I settled on years ago. And you can see here, I have these circles, right? When at different market conditions, the line's at a different level. Back here, I would have had the line about right here where I'm drawing it. That's where it was extreme low volume. Again, on the 10-day moving average. And then since 2022, remember we entered a bear market. Typically, volume goes up when stocks are falling. You typically see overall volume, the average volume, increase. And so then the line had to be raised, and that's when I've had it here since. So I circled, you can see right there at the top, that's when we dipped. The 10-day EMA hit that level. We hit it again here. I'm just going to circle, and you can see what happened afterwards. We hit it there. Right there. I did the purple lines, you can see. So they're all there. Boom, boom, boom. We did have one here that did, yeah, actually, you know what? It did. It resulted in this drop that we had right here. That's that. Remember, we're zooming in, or we're zooming out here. That's that 8% drop in QQQ we gamed down from the top, even though we're looking at SPY here. And you can see it came not right when the level was hit, but shortly thereafter. And here's what I wanted to point out. Volumes are plummeting right now. What does that mean? It means we just broke out. One thing I've talked about a lot in the past, I haven't said it much recently, in breakouts, whether it's especially long side breakouts, short side breakdowns, short setups out of a break of support. It's not as important, but long side breakouts even more so. You want to see them occur on above average volume. Typically 1.5 times or better. Your broker, any broker will give you somewhere in there, you got to find it, or charting platform, either 60, 90, or 100-day average volume. And so typically breakouts that occur on above average volume, 1.5 times or better, are much more likely to stick than those that occur on average or below average volume. So all I can tell you is volumes have plummeted here. We haven't seen volumes, again, the 10-day EMA, that's what we're looking at. That's the blue line, since back here. And it wasn't a sell signal right away. There was a shot across the bow first. Then we pushed on up. Volumes plummeted again when we got to the highs. And then from there, we really didn't go any higher. I mean, that was it. We made a marginal ever so slightly high. Also, there was then divergences in trend line breaks and other sell signals. So I did want to point that out for you guys. It goes into my analysis for sure. QQQ, I have the magic number at, let me find it here. I've got one of these boards. There it is. Forget about all these lines up here. Just look at where we're at now. So really in the past year, so really since 2022, this is the line, this white line here. Remember what I said. This used to be what did the trick, really low numbers down here. Since 2022, volumes have been higher. I'm going to circle real quickly the times we got down to this white line. What is that? 376 million, something like that, whatever the number is. Billion shares, I don't know. There's the previous high right there. We hit that level there. We hit it again there. Remember, QQQ double topped. We came very, very close, not all the way there, but you could see the notable drop off in volume there. Another drop off, came close. And then this is where we've been riding on it here lately. And again, if you go up, follow the lines up, each time we see that drop off, in other words, you're rallying, stocks are going up, but then volumes are dropping off. It just shows that at that point in time, dryers are kind of buying up, short sellers are kind of giving up, the market's just drifting up on fumes, and I just wanted to point out we shot down below there. Now we may go down into a new era of lower volumes like this. That is possible. I'm going to again give you the levels where I'm going to be, from right now at this point on, where they're going to make or break the rally, and that brings us back to Treasuries. I don't have the low volume indicator on Treasuries, but okay. So back here recently, if you recall, went long Treasury bonds when I started. Oh, let me back up. Before that, let's not forget, as I said this morning in the post, QQQ hit T2 right here, and you see my crosshairs, a pop-up box to the left. That was April 19th, right? This whole thing, make no mistake about it. You can say what you want, but it was unarguably, in my opinion, due to, you can say it was earnings from FANGs, and I'll get to that in a second because there's only one of the Mag 7 new highs, I believe, if I'm not mistaken. We'll get to that in a sec. Yet the market went to new highs here. And so it was mostly, or all, in my opinion, very largely attributed to the rally in bonds. Now, I also mentioned, starting to, after going long there, gaming the initial bounce and scaling back in short, and also taking Treasury bonds as a hedge, because if bonds went up, that means rates are falling, so the stock market would rally. So anyways, that was, again, what I just say, April 19th. And then you go back to TLT, and make no mistake about it, there's April 19th is right here where my crosshairs are. So it wasn't exactly the bottom, but effectively. You're talking, here, I'll just measure it for you. So we dropped another 1.28% on TLT. So it was effectively the lows were close enough. And then it came a few days earlier. And why? Because, you're going to have day-to-day variations. When I talk about these correlations, it's with stocks, at least with stocks and interest, it's not minute-to-minute, tick by tick. Over time, as a trend develops and more see, okay, you start taking out previous reaction highs. Oh, yeah, we're in a new uptrend, meaning bonds are going up and the interest rates are falling. So there it is. So from there, that's when T2 was hit. And again, this is far from mere coincidence. And this was also, I posted it back around that time, this would be my max bounce target. I did start shorting recently, right the week before I went away, Treasuries, but I said easily I could see it going up to here because TLT wasn't at resistance. IEF was at downtrend line resistance. I'm going to get to that in 1 second. But TLT, this seemed like a very likely target, and there it is. And look, we've reversed. So yet the stock market's up. You might be saying, okay, well, treasuries are going down. Again, this right now, isn't enough to establish a trend. Now you have a potential uptrend line. You have support. That $91 was a upside resistance level, was taken out. So the way it works is if and as we continue to do this, gradually but incrementally in an accelerating rate, again, this is a big if, the market will start to get the memo. And so that kind of meshes with what I'm looking at. Now we have that equal, and I can see a little bit more marginal new high in QQQ. And then we start taking, the turn comes, and then we the breakout that we just had fails. Again, you can go back for a while now. You see these breakouts to new highs, market cheers it, and then there's a correction. Now, yeah, ultimately we've been stair-stepping higher, so you can buy the dips if that's your thing. I'm a swing trader. I'm in and out, long and short. Just wanted to tell you this. I can tell you definitively that's resistance. I can also say that if they can take it out, as I said this morning, in anything but a false breakout or a brief whipsaw, and again, it's not all or none. It is more incremental. Now, a breakout in itself will be a bullish technical event, no doubt. A solid breakout, and you want to play it safe. You can go to a daily chart and say, okay, well, I might get whipsawed if I take a breakout on the 60, so wait for a solid daily breakout above that downtrend line. It's very clear, and that means rates are going lower, and that will support additional gains in the stock market, or at least it's a net positive. I can't guarantee it because I said there is a possibility we see this because all of a sudden the stock market breakout fails, it starts going down. Let's say NVIDIA shits the bed on Wednesday. If they do that, then I promise you, because I've said this before, as we went into earnings before with all the big fangs, there were a lot of them, but nothing to me, even Apple used to be the king of stocks. Nothing is more important than NVIDIA, because this market is built almost exclusively on this AI hype. And again, you're seeing it in the earnings and just the guidance with the big tech companies, the amount of money they're spending on it. And we'll see. I can't digress on the fundamental part, but I just wanted to mention this is it. So there's an uptrend line. We're at resistance. The PPO is still in bearish territory. I covered that before, right? And when it's down here below the zero line, the primary trend here is bearish. When the PPO signal line crosses above, as it did from here to here, the trend is bullish. And when it crosses back below, as it did right here, I'm looking at the white line, the trend is bearish. So that and this, there's every reason in the book to short treasuries right now, to be short treasuries. And again, it's just like shorting the downtrend line. If you did that last week in QQQ, you just have a stop above. So it's very simple. You almost have to be mechanical on this. It's either going to play out or not. And again, if you are bullish, then this is what you want to see. You want to see a breakout there, and you might want to hold off till you see that breakout. Or if you're long equities now, just keep an eye on this, because again, with every tick lower, it starts to build a case that treasuries have been rejected here at resistance, and they're going to go lower, and that's that. About 30 seconds ago, if you heard a little alarm dinging, that's Palladium. I had a price alert go off. Palladium, I've covered it not super frequently. I've a couple times lately. I liked it back here off this divergent low. Would have shared this chart either in a video with you. We rallied up. We just hit a primary downtrend line, so I wanted to point that out. And if all I can tell you, we're at resistance. Coming off a big divergent low. If we break out, Palladium is probably here. Let me give you one more level if you're trading it. And I didn't mean to digress. I'll cover the precious metals in another update. I definitely want to. There's some things I want to point out there, but I just wanted to say Palladium, if it could take out the trend lines, headed up to about 150-ish right there, and then potentially up there 110.73. Otherwise, like I like to say, resistance is resistance until and unless broken. So I'm only covering that again because the alert just went off. Okay, before I move away from the markets, again, quick overview. I already covered QQQ, again, at a marginal but yet divergent high, marginal new high and divergent high. S&P 500, same thing, with the divergence is still intact. That trend indicator down here, at least, is bullish, still above the zero line. Interestingly, the equal weighted. So what this rally is about, besides the AI hype, and remember, the AI hype largely benefits big tech right now. Microsoft, Alphabet, those that invested heavy. Now Apple's getting in the game. But interesting that the equal weighted indexes have not taken out that previous high. They broke down here, bearish rising wedge, kickback rally. If they do happen to anytime soon, any equal or marginal new high will still be a divergent high. You can see with these indicators lagging. That's RSP. QQQE is the equal weighted. NASDAQ 100 also still below the previous highs and back in that trading range there. So that's kind of that update. We'll watch those. A couple indicators I wanted to show you. Again, it just kind of speaks to overall market breadth. And so what this rally is about, as much, if not more than anything, I think are these big stock buybacks, these cash rich, Apple, Alphabet, Meta buying back their stock. But when you look at under the hood, and I just showed you the equal weighted indexes failing to make new highs so far. Not that they can't take it out, but they haven't. This is 50% right here. This line I'm drawing, I'm going over the black line, this is the percentage of stocks trading above their 200-day moving average. So typically in a bear market, or a correction. This was the last real bear market. This was 2000. There's the top in 07 right here. That was at 55-ish% drop in this is the NASDAQ here. And you can see throughout the bear market, the majority of stocks were trading under their 50-day moving average, meaning if you're under the 50% line, more than half the stocks are trading under their 50-day moving average. And you started to see that. There's two takeaways from this chart. As I say here, divergences between, a little typo there, divergences between the NASDAQ composite and the percentage of stocks above their 200-day moving average are usually followed by substantial corrections. So for those of you that say, man, you can't just shake that, longer term bearish outlook, that's what happened, and it takes a while. That was a couple years where we built up to that high. Fewer and fewer stocks trading above their 50-day to hit that divergent high. Bear market. Then you had another divergent high, 20% drop, 20% drop, 12. These are just the measuring 18%, 25, 30, 36. That was the last time. Again, wasn't random heading into the 2022 highs. And here we are. So not only do we remain below the 50% mark right now, and we have pretty much throughout the top. That's why, to me, despite one or two indexes or a handful of stocks, or not handful, but the minority of stocks making new all-time highs, this to me still, is effectively a bear market with a double top high, potential double top high right there when you look at it this way. And this tells me that. And the other thing here, you can see this little box down here. This is where bear market ends. So all my sentiment, my put to call ratio, a lot of things didn't indicate there was nothing remotely close to a selling climax or a capitulation at the bottom like you usually see. And this is where, bear market end. COVID was certainly a bear market. It was 30+% in the NASDAQ, 36 in the S&P. That's where we got. We never got there before. So that when you get that, you've got that final capitulation. And so that's what I wanted to point out. Now you can do the same thing on the 50-day. This is the 200-day stocks trading above their 200. Here's the stocks trading above their 50-day moving average in the NASDAQ. And the same thing. You've got that negative divergence right now. Actually, it's even steeper. Let me show you here. You got, I have to annotate. I'm not going to, it's going to take too much time. I should extend that line out. And this one, I'm not using my line tool, I'm trying to make a line. That's very steep divergence. So what they're showing you is the percentage of stock. Oh, there's my line tool. It's dropping off significantly. Translation, the handful of Mag 7, your Alphabets, NVIDIA, and that's pretty much it. So those are the guys making new highs. And if I didn't have things like this, I couldn't. It'd be very hard to make the case for the big drop I'm still looking for, 50+%. This to me again seems like just an unusually large, but not completely unique. You always see that breadth deterioration towards the end of a bull run, where you have the majority of stocks going down or not going up anymore, and just a handful, because these are cap weighted indexes. The NASDAQ 100, S&P, they're making new highs, but as I just showed you, the equal weighteds are not. And that shows you what's kind of under the... Okay, and the other thing that I was highlighting before I left last week for vacation was this symmetrical triangle in the Euro USD, and I clearly stated that I couldn't really tell you which way this is going to break, because by definition, symmetrical triangle patterns are indecision patterns. It's the way I've always viewed them. And I said an upside break, because this is the stock market, is correlated with euro, meaning when the euro is rising, the dollar's falling, stocks go up. There's that rally. Is it mere coincidence? Where do we hit T2 on QQQ? Where do we reverse, cover, play, bounce? Right here. This is when... And so we rallied up, and then that last little leg, when I was out of town last week, or I guess that's when it happened. We took out the top of the triangle. That was a breakout. That's bullish. And that, again, if it didn't support the reason to go long for you, it at least said, hey, don't short. The euro just broke out of a pretty clear symmetrical triangle pattern, and it ran, and the stock market ran with it. Now we're at resistance. These lines were here before. I haven't touched this chart. In fact, you have a reaction high there. I'll touch it now. We have a reaction high right there, and we pretty much stopped at that previous reaction high. I don't have a strong opinion on it. There is some divergence here on the RSI. It did just break out, but kind of my thoughts on the market levels to watch. Here's an uptrend line right there. So if that trend line breaks, then that's going to send the euro lower and the dollar higher, and that'll bring stocks down. So throwing a lot out here for you, but these are the important things. And they all, guys, by the way, they all go together. It's all interrelated, is why I do these long-winded videos covering different sectors, but then Treasury bonds. And now we're going to go to the what formerly known as Mag 7 stocks. So here's Microsoft. No new high. This is still the high. So let me change that tool color. That was a divergent high. BOD, benefit of the doubt, trendline break, drop down. Microsoft pre-earnings had a brief whipsaw down below that. That's the big level. Remember, I had these color-coded levels. 397 needs to go. That one had to be taken with a grain of salt because it was pre-earnings. Microsoft's been moving up, but it's still, you know, it's closer to its highs than it is to that level right now. So, you know, if it breaks out, but look, if it breaks out anytime soon, it's still going to be a divergent high. So to me, the breakout will likely fail. I'll say that right now with convictions that I always say that. Breakouts that occur with negative divergence in overbought conditions have a higher rate of failing. And I still think Microsoft and the markets are going to come down here and visit the 200-day moving averages. And so that's it. So we just need we don't have any sell signals now. In fact, the only thing we have in the last few days is a buy signal when we broke out above the downtrend line. So we're waiting kind of for the next sell signals. I think they're going to come, and they might not be clear. I don't have at least a lot of very, very well-defined uptrend lines. But if the breakout fails, that in itself, I'm talking about QQQ, the breakout to above the previous high, that in itself will be a false breakout, and that could be quite bearish. Apple, still well off its highs, so that's two of the, and those are I'm doing this by market cap. Microsoft, the largest, yet to make new highs. Apple, no new highs. NVIDIA, again, this is everything right now. NVIDIA reports on Wednesday. They had that one little brief whipsaw there, broke below the trading range. We're back in it. That is still the high right here. We had a bearish engulfing candle and divergent high. We remain below it there, and we're in that trading range. So they're going to report Wednesday. They're probably not going to do much. If I had to bet on it, well, I'll tell you right now, I'll play that game I usually do going into earnings. You know, I had I don't know, 50-50 on the last time around, if that. But based on this chart, there's big old divergences. That was a bearish engulfing candle, divergent high. And I can say any marginal new high, even if it pops 20%, it would have to take out a lot more than that to take out these divergence, go up a lot more than that. So any new high anytime soon, as you can see, I'm putting these lines here, will still be a divergent high unless it can power on through here, take these lines up, 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 and away. That's it. So I almost say you could probably short a after hours pop or pre-market pop or next day pop. We'll see. I'll watch it. We'll stay on it. I've got just a small position in this one. I shorted a couple weeks. I didn't put it out as an official trade idea, and I'm going to ride it into earnings because I believe based on the technicals and the fact it's overowned and overloved. Plus, I have a lot of other offsetting positions right now. Commodities have been ripping, so actually even getting stopped out of that small NQ position last week. Had a great week. Natural gas is on fire. Wheat's doing great. I got to get to crude. I like crude right now, as I told you last week. But that's NVIDIA. Again, so 1, 2, 3. The top three, still none of those made new highs. There's Alphabet. This is pretty much the only one right here making new highs. And you can see still very, very much big divergence here on this daily. And like all of them, you go out to the weekly, you can see the divergence there as well. So we need to see if there's going to be a catalyst. As I mentioned earlier, there's some things on the economic calendar this week that could rile the markets. It could build on the gains too, guys. It goes the other way. If I say one thing's going to be bearish if we do this, then it only makes sense the opposite, like that trend line in TLT. We rallied in the trend line. I expect a pullback. But if we break out, then that's net bullish, because that means rates are going lower. So, and same thing, we'll see what happens there. But so I'm still looking for, break. Alphabet needs to break 149.46. That's my yellow level there. And then you have this longer term trend line here. You get the 200 days. And this one's got a long way to go to come visit the 200-day moving averages, almost about a 20% drop. if to get there. And if it does it might come in here back down to that 149.40ish level. 200s may continue up a little, and then boom, boom, something like that. All right, so there's one of the Mag 7 that is at new highs. Amazon didn't do it last week either. That last previous divergent high so far was the high. Big divergences there, and not really going down, but not going up. Just wanted to point out that that none of the Meta still well off. That we had a divergent major sell signal. Remember, Meta on earnings, that one gap down, as the charts indicated, was most likely divergent high, breakdown above the trend line, and right back to where it gap down below there, and that's that trading range it had right before earnings. It's rallied up to test, and so that's pretty significant resistance, and it hasn't made it down to the 200s yet, which I believe it will. And that's it. The rest aren't really in the Mag 7, but this is Broadcom. It's up there in QQQ. It's one of the bigger, components. I think the 6th largest, 7th largest. Divergent high popped last week. That one did make a high. We're a little below it right now. So the breakout so far, I'm not going to call it a failed breakout, but it's back below there. And it, for all intents and purposes, it's still, this is it. It's still grinding around in this range. And I have to extend my divergence line. That's it. So there it is, guys. So like a lot of stuff, like I just showed you, most of the Mag 7 haven't made new highs. They're just kind of grinding around. Tesla, not even close. And we'll just end that there. I'm just going to keep it going. We're 41 minutes into it, but they're all related. So I'm just going to talk real quick. DJP. This is a broad-based commodity index, ETN, the UBS commodity index, and this is inflation, my friends. This is what inflation looks like. This is what ultimately it's the closest thing we have to a real-time indicator. It is skewed heavy. All these broad-based commodity indexes are skewed heaviest towards energy, but energy is also one of the biggest components of the CPI. And again, so I went over this last month before the CPI, or 2 weeks ago before the CPI print, showing you that we had a net considerable increase. CPI did come in slightly. I think it was a tick higher, 0.1% higher than expected. And I don't think it was fully reflected. Remember, there's other components in there. Plus, when wheat, which has been going up, remember wheat and soybeans and the other grains, cocoa, those things, they don't have an immediate impact on the CPI because those are the raw commodities, and so I always say food producers don't instantly price that in, but over time they will. You keep seeing a trend, and so I just wanted to point out so that was last month. So I think the CPI was not. A lot of this stuff has a lag time, and here's what's happening so far this month. This is ripping. So that's going to be no bueno unless this stops. And guys, by the way, look at what we have here. Let me go back to this chart here. There it is. There's a line right there. This was resistance. This was a big resistance level. What do I see? What do I spy with my little eye right here? I see a new trend. Okay, this was as rightfully so at the time, we had a divergent high right there. This was the first leg up, I believe, in a new commodity bull market, new inflationary environment. Commodities ripping, but they put in negative divergence. Nothing goes up forever. They had a hell of a run, and I made the case that this is a corrective wave based on Fibonacci's, based on the charts, previous reaction highs, lows. And what you can see here, I can tell you definitively that we took out these previous highs right here. So this was resistance at 33.16 level I had. In other words, we had a correction, and the talk has been kind of sticky inflation, right? And so inflation stopped going down, but it wasn't going up, and the markets cheered that. Well, guess what just happened? Since I was gone, this was a Friday right here, breakout. Followed through today. That is a clear breakout. If it fails, it fails. There's some negative divergence, and maybe it will fail. But if it keeps going up, these divergences are going to get taken out. And I look at this longer-term weekly chart, and so I made the case. Started getting back pretty darn bullish again on commodities here for this reason. DJP, some other broad-based commodity ETFs I threw out there. So that's it. And there's your Fibonacci retracements and all that down to the 50. This is a 50% of this whole move here. We pulled back to the 50% fib. We pulled back to very nice price support. And so if this continues on up, no bueno for the stock market, because yields will reflect that. This whole hopium, don't even get me started. We're exactly where we've been at other points in history, where the market, but more so now than ever I've seen, the market is cheering. It's rallying on bad economic news. And we've been getting more and more of that. I don't have time in this video. I'll do it in another video. But all the accurate leading indicators, not the coincident indicators, not the lagging indicators, the leading indicators, including and not limited to the most important employment, starting to turn now. Industrial, manufacturing, all those indicators are rolling over, and the market will rally on. We might get another quarter point, 50. The Fed will cut, but like I said, careful what you wish for. Anyways, that's that, guys. There's the inflation overall. Wheat. Remember, we hit T1, we hit up T2. Did I not? I thought I updated that before I left. T2 has been hit here on the daily. Still looks good. Coming off a big divergent low. I still maintain these additional longer-term targets. Remember, we broke above that $6 level. To me, that was huge right there. It was major resistance going back for pretty much, well into almost a year now. Boom, 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 boom. And now breakout. Nothing but bullish. There was a little uptrend line, but got taken out. And like I said, they stepped in and bought. Look at that. Perfect. If you missed this breakout or you haven't been in wheat and you were looking for an area to get in, right back to that 607 level I've been highlighting for close to a year now after the breakout. Perfect back test. So now if we can punch through that high, we should continue on up. Corn, soybeans, like I said, they're related. They're going to follow to a greater or lesser extent. T1 hit, next target's there. SOYB, soybeans, T1 hit. Powering back up, should punch through there soon. Hopefully continue on to those targets. Don't get married to these things. They've had some fits and starts before. They looked like they were going and didn't. But anyways, it's still constructive. USO. Well, I'll do UNG first, then USO, and then we'll kind of wrap up here. UNG, as you know, beautiful little trade here. We've been buying it here around long-term support. And 40% gain so far. We took out T4. I gave you on NG, natural gas futures, longer term target if you're so inclined. Like I've always said, do not underestimate how far and fast natural gas can run. If you try to short overbought, you're going to get, a lot of times you're going to get clocked. Natural gas makes overbought. It just goes right through it. When it wants to run, it can really run, especially when the charts are constructive. And that's nothing but, just nice, beautiful looking chart here. And so before I left town, it would have been the week before or whatever, I gave you these longer term targets on natural gas. And that's where before all said and done is where it's most likely headed. Like I said, we're overbought. We hit T5 or whatever I had last week on the 60-minute chart. But that's going to be about a 62% run to get there. We're already about 44% off those lows. Again, we're getting stretched. I wouldn't chase it here I wouldn't chase it at all. And again, my preference, I took profits on Friday. I kind of wish I was still in it, but that's it. I just wanted out when that T5 was hit. It was actually a little past it when I got home and saw that. So that's nat gas, and again, it doesn't have the impact on the inflation, the same impact that crude oil does. But I'm going to get to crude next. There's an uptrend line. When that breaks, we'll probably get a correction. So and here's a reaction high. So it's probably gonna do this. They're gonna take some profits soon. You can maybe hold the trend line and run up there. But if the trend line breaks, I think a pull back to that 237 level. Would be an objective long entry there, re-entry. And then CL crude oil futures right here. I'll get to USO in 1 second for you. This is what I highlighted for you. The contracts have rolled. I'm on the Julys now. I think I was sharing the June contract with you before, so I had to mark this chart up. July is the more active. We've rolled into that now. I've rolled into it. I think most traders have. There's positive. Remember, we had positive divergence at support. This was that same level I was targeting, on the June contract. Started scaling and throwing crude out as long down to with an ideal entry on the trend line, and look at that, we hit it. Even better, I'll tell you, this is the July contract. We punched through it ever so slightly and immediately reversed. So if anything, that's net bullish. That's a whipsaw, false breakdown. If it bears, somebody was looking to short crude, they might have shorted the break of the trend line and then realized rut-row, crude's rallying up. So now we're at downtrend line resistance. Which I expect will pop. We're at resistance. You don't buy resistance. You wait for a breakout. Maybe we pull back again. If you get another pullback to the trend line, that's also an objective entry or add-on. But a breakout above there should bring us up to that 83.61 level. That's going to be roughly 5% run if crude gets there. If it does, then that can't be spun as anything but net bearish for the stock market because, again, nothing out there in real time, nothing that we can track in real time, minute by minute, tick by tick, has the impact on inflation that crude does. Again, so it's waiting. And there's another target right in the middle. I think we'll have a reaction at about 81.50. So those are your two targets on crude, but you got to wait for a breakout of this trend line here. And for those of you that do not trade futures, you have your USO. Same thing, beautiful uptrend line right there. Nice divergent low. I like me some divergent lows. Boom, rallying off that trend line there. And what I'm going to do right now is add that same downtrend line that I showed you on futures, CL, and that's it. So it works like this. Resistance is resistance until unless broken. So maybe another reaction here. You also have some that was price resistance there, a little, you can see it. So just pop that. I think we're going to power through here soon and break out and then run. I don't have all the targets marked for USO. If you want targets, let me know and I'll be glad to mark it up. And then you look at this chart's just been beautiful. I haven't touched these zones in a while. I gave them to you a while back. Red zone meaning the stock market will freak out. Orange zone meaning the stock market will take note, which it certainly did. That was the catalyst for that 8% drop we had in QQQ down to T2, right? Actually we entered the yellow zone. Market doesn't like that. And so in the red zone, when we hit the red zone, I said you can short crude. Whether it's a direct play or an indirect hedge to your QQQ short, because if crude falls, market should rally because that means inflation's falling. And likewise, we hit the yellow zone the other day perfectly down there, that's $74, and so far we're bouncing. So PPO is about to turn up here, and crude was oversold recently, just like the last time it was there. So lots to like there. So that's it. There's everything. And 52 minutes. Okay, I'm just going to do it. So I didn't, like I said, I didn't go through. There was just too much when I got back this weekend. And there were too many posts to read. But I started reading the threads and I was out and, you guys, some of you were gaming these meme stocks. And someone even said, yeah, it's based on, these are my kind of charts. Now, I don't like, this is not my wheelhouse. I don't care for these meme stocks, but they tell you a lot. They tell you the animal spirits are running wild in the market once again. What I mean by that, the last time AMC was, all this buzz on GameStop and AMC was right here. They had that, remember that big run up? When did that happen? The middle of 2021. When did the NASDAQ peak? In November of 2021, right after that. So there was AMC, and so I wasn't on my radar. And remember, I'm not a machine. I'm not all seeing. If someone would ask my opinion, I would have given it. You had positive divergence. You had a nice clean downtrend line. They popped that, and they went right into resistance. This is where I would have had. I marked this chart up just today, but that's where I would have had the line anyways, because there was a 10 to 1 to 10 reverse stock split. A major reaction high right there, and that's exactly where they sold it. And then see what happens. It's just gambling, guys. If you can get in, and the breakout was legit. I mean, you can see it. And if you looked at it 1 minute, there was plenty of opportunities to get in above that trend line. Trend line should be a little lower. But then they, if you bought it that day or the second day, stock dropped 62% already. Look, if it can pop those highs, then that's where it's going. There's a downtrend line in 38.81. But again, these are junk stocks, probably going to go to zero over time. And the other one is GameStop, GME. I forget which one you guys were playing. Maybe both. It was in the in those comment sections from that last post I made before leaving town. GameStop, GME, same thing. Positive divergence, beautiful, clean downtrend line in which to trigger a long entry. Right there, very well defined. Numerous reactions. And it was easy to, it wasn't anything that gapped and ran away. It broke out. A lot of volume coming into the stock. You can see the volume bars, and it ripped up to these reaction highs there, and it's all gone now. Most of those gains have been faded because it's a crap stock, meme stock. But it just shows who's in the market. So again, if you guys ever want updates on these going forward, let me know. Drop it in the comments section. I didn't have time, like I said, to read all the comments. If you had any questions in that post with 100 and something comments before I left town, please repost the questions under this one, and I'll do my best to get back to you, whether it's a chart update or anything else you're looking for. I think I covered everything. It's a long video, but again, I wanted to kind of throw it all in there because to me, they're very much related. Interest rates, treasury bonds, crude oil, and the impact it has, and natural gas, and overall, even the ag commodities. The ag commodities do not move the needle as much, especially on a tick-by-tick basis like crude. But it's, again, a trend. Like I said earlier with treasury bonds, how they reversed a couple days. The stock market bottom, and then right around there, the treasuries bottom too, and treasuries started rallying, rates started dropping, and that supported the rallying equities. The same thing kind of holds true for, these commodities, that it'll, after a while, when the street starts to recognize a new trend has emerged, if I'm right, and we start seeing wheat and corn and soybeans and whatever else, cocoa's not going to move the needle as much. These guys are bigger for ag commodities, and especially crude oil. You can just watch DJP if you want. And so it's not binary like all or none. It is a breakout, and that increases the odds that we're going to continue on up. There's some divergence, and if we pull back to the trend line, well, there's a trend line which to buy. But if you start to see us, continue to zigzag, making higher highs in DJP or any of the broad-based commodity TNs, that's going to a greater or lesser degree, handcuff Powell and company with their, what they're going to do as far as how much and when they're going to cut. So that's it. Wrap it up here, get it out to you, and I will continue to hunt for some new trade ideas, but that's what I'm looking at now. This has been Randy Finney with Right Side of the Chart. Have a great day.